Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, back here on February 14th. How's it going today?
Great. Hey, happy Valentine's Day, buddy. I love you.
Hey, happy Valentine's Day. This is the place to be. Let's see. So keeping up with the Valentine's Day theme of energy markets, I don't know the connection there.
Whoa.
We'll just go to OPEC and let you maybe kick it off with the OPEC data this week, and we'll go from there.
You know, the OPEC changes or lack thereof, I should say, really not a lot of news from the monthly oil market report, certainly as it relates to the EIA's short-term energy outlook, which came out a day before on Tuesday. You know, the short-term energy outlook revising historical supply higher 2024, also making a similar change for 25. Just a further loosening of global balances. And there's this contrast right now between what is being reported for global inventory levels, which, you know, for anybody that wants to look, I'm sure Alex will have some show notes, show that the chart is a bit broken. Global inventory levels still very low. That's often been, certainly all of our clients have heard that, one of the primary tailwinds for the market. And then when you think of balance loosening, how long could a looser market persist without that inventory dynamic changing? Well, one of the interesting data points, sorry, I'm getting a little bit away from OPEC. We'll come back to them. Just kind of sticking with the DOE. The DOE stats after these revisions for 2024 suggest that global oil demand and global oil supply were at parity. So we were neutral. We're neither over or under supplied. Yet inventory levels are low. So for me personally, I think the only conclusion to draw is expect more pencil whipping of the past. The revision train has left the station, and not that it's really something new, but expect meaningful revisions to both history and the future to continue in significant quantity.
That's kind of been a theme that we've noticed with OPEC as well. And so you're saying now the DOE numbers are kind of following the same thing?
Yeah. And, I guess turning back to OPEC, the one thing that OPEC and one of our colleagues, Matt Parker, the esteemed leader of the Mobius strategy group, I think aptly points out often is that last year OPEC's forecast for global demand growth was more or less just a reflection of how much capacity OPEC had on the sidelines, meaning spare productive capacity that was literally waiting at any minute, meaning at a price level that is still hotly debated. And those forecasts from OPEC were almost like clockwork every month for many months, revised lower. And now, while OPEC has still a lofty goal for global demand growth, I believe it's 1.6 million barrels a day for 25. It's fairly similar to the DOE's and at the upper end of the historical range for non-recovery years. So I don't think there was really anything too remarkable from the latest monthly oil market report other than one comment that came out of it. I think one of the most interesting things out of this month's update was the comment that President Trump's trade policies would be likely to stoke some increased volatility and risk in global oil markets. Or I guess if I want to get really precise on the quote, it would add more uncertainty into markets that were not fundamentally driven. And I think that maybe is really where we are. And while the front of the TI curve and the front of the Brent curve are just limping along at very benign levels, a little under 71 these 5 minutes and a little under 75 at the front of the respective curves, and with very, very little backwardation and monthly spreads near the front. Yeah. I think that's really where we're going are these trade policies going to lead to some enhanced volatility in what has been a very low vol environment for what feels like 2 years now.
Yeah, it's been interesting on the OPEC versus IEA versus EIA demand forecast to see that discrepancy narrow from where it started, I guess, kind of at the end of 2023, where I think you might have the exact number, but OPEC was, I think, starting out around 2.5 or 2.4 ballpark.
That's correct.
For 2024. And the IEA just steadily reduced its already much lower. I think they started at maybe 1.2, something around there, and then cut it down to, I think, 900,000 of growth for 2024. So I think that delta was the widest in almost a decade and a half, and pretty meaningful difference if you're trying to make a decision on what demand is going to look like. And what's your take on how that panned out last year? Do you think OPEC was off?
I think you got to start with, like, who are these entities? What is OPEC's, goal? What is their mandate? Higher global oil demand. Should it be a surprise that a consortium of countries that are highly levered to the price of oil and thus their production helps to support their economy? Probably not. That's exactly the way it probably should shake out. And then the IEA, who are they? What do they want? What's their mandate? Generally I'm going to call it a European anti-fossil fuel related fossil fuel forecasting entity. So It probably shouldn't be.
The incentives are crossed. Yeah.
Yeah. Who's low, who's high? It should probably stay that way. The narrowing, and I guess maybe the DOE getting it the most right is, and I'll leave the Department of Energy in the middle as I don't know that they're sure what they want. And that is just a function of the Department of Energy gets rebranded every 4 years with a new executive branch who's nominating energy secretaries. So I think maybe it gets to be the most right because it doesn't know who it is or what it wants for any extended period. Go ahead. I'll pass to you. Like you're ready to add it. Chime in there.
Yeah, no, it's more, I think, just when I think about the long-term side of that, it's interesting, talking the incentives. OPEC has commented probably the most of any of the forecasters about the long-term risks from underestimating how long we will use petroleum and natural gas and fossil products, which I think is a real risk, especially when you think about how many or what share of the world's population still has what I'd consider energy poverty and therefore, limited opportunity for economic growth, because those two go hand in hand. So I think there is kind of a interesting short-term versus long-term debate on where those incentives ultimately lead. But, we can get into some of the more interesting sides of what's been going on recently with energy markets. And we had President Trump pick up the phone and call Russia's President Putin for the first time, reportedly, since 2022 for a U.S. president. What's your take on where that's heading? And I know we had some reactions to that in the market this week.
It's hard to say whether or not the oil market backpedaling from early week highs is a result of that or not, because it hasn't really moved that much. We finished last week around $71 a barrel. Here we are precisely a week later, right at $71 a barrel. But I think it is really interesting in that, and this is, should have been expected, to be honest. I mean, I think on the campaign trail and even after being elected, he made it abundantly clear that his intention was to work directly with Vladimir Putin to bring about a swift end to the multi-year conflict between Russia and Ukraine. So why it would have come as a surprise to anyone, can't really make sense of that. However, I think the reactions to it are what's pretty interesting. So you've got more or less the entire European continent saying, whoa, wait a minute. You can't go about, I guess, kicking off these peace talks by starting with the aggressor and then almost as a courtesy calling the Ukrainian president Zelensky and saying, hey, this is our plan. Are you on board or not? Now, there's that reaction from European leaders. However, President Zelensky goes out and immediately, and I'll just take the smallest portion of the quote that I think is the most interesting, let's get it done, meaning let's bring about an end to this. At the same time, you had Pete Hegseth, the new U.S. Defense Secretary, at a NATO conference, making it abundantly clear to all NATO members that there is zero path to restoring Ukraine to its pre-2014 borders, meaning give up on Crimea. And by the way, we're kind of out as your financial backer in this, agreement that is, I think in some ways is at the core of the conflict between Russia and Ukraine. So the new U.S. administration's stance on its participation or financial support of NATO is not any different than what it was, for the majority of the prior term of President Trump. And if you go back to why all of this started, in a lot of ways, it did appear to be the encroachment of NATO forces towards the Russian border, which was
moving east.
There was a promise from the beginning. We wouldn't do that. You are you, and we're going to protect ourselves. And then, so who is really the aggressor here? Is it NATO and Western forces with Russia? Golly, Ukraine caught in the crosshairs.
Yeah.
I don't know that we'll ever unpack that, or our kids 40 years from now will learn about it in a textbook. And as usual, history will be written by the victors.
Yeah. It does seem like there is interest from both sides to kind of bring this to a close. There's a few interesting side topics that we can go down. One of them, when President Trump was talking to President Zelensky, all the funding that we've given Ukraine, I think there's some interest in kind of using that as an inroads to getting some of Ukraine's natural resources development going and having U.S. involvement in that, which will be pretty interesting as well. So Ukraine's rare earths, and I know their natural gas is a big one. Did you have any kind of thoughts about where that could go, and if there's any notable impacts that people should think about, or if it's just kind of an interesting?
Yeah, it's not like Europe is in any way going to be a global energy powerhouse, but it is important to note that European gas production has been cut in half over about the last 10 to 15 years. So could enough investment spur development? Well, undoubtedly. If you went to energy conferences as recently as, the last, 5 to 7 years, the beginning of that period, you would have, heard from small companies that would have stood up there as speakers and told you about the prospects that they were targeting predominantly in Eastern Europe. So the potential is there, and it just butts up against the same theme of, are we anti-fossil fuels or not? I think Europe's identity as it relates to energy is in flux. We go through a decade of canceling all fossil fuel plans. And now, I guess beginning in 2022, I guess we're still pretty reliant on this. Back to your point of, OPEC's views that we consistently underestimate how long we're going to need fossil fuels. I think both you and I would, speaking for you here, so step in and correct me, would lean to we're probably going to need a lot more of them a lot longer than people think.
Yeah.
And so what do these political machinations lead us to? Is there greater European energy investment? Remains to be seen. And what I think is fascinating is not just Europe with this, potential to bring in U.S. dollars, maybe not to NATO, not for defense, but for energy security. Security comes in many forms and fashions: defense, food, energy. You think about like the big three: protect myself from bombs and rockets, protect myself from starving, and ensure that I don't freeze to death or burn up.
And in many ways, I feel like energy is the kind of the tip of that pyramid, where it kind of controls many other aspects of any country's security. So without, energy security, you're not going to have defense or food security. So, interesting stuff there. I think the ETF, I think this is one of the questions that I think will be interesting to talk about. So TTF yesterday lost about 8%. And we had the news about Trump calling Putin and Zelensky, but we also had the European Commission going into a Thursday meeting with all of the member states to discuss the end of their storage mandates, which we talked about last week as well. I think the question that I had is that reaction more connected to this conversation about the end of storage mandates that have created kind of a forced buying kind of scenario for storage operators, or is it more connected, do you think, to long-term seeing more Russian gas back into Europe where it was before?
I'm going to say it's neither and point to one of the daily write-ups that you put out this week. I think it's because the specs that had gotten long and stayed long for quite a while, meaning speculative market of participants holding net long positions in TTF, caught quite a rally, from 12 to, over 17, some gifts given there. And so and then I guess I will say it's related to one of your points. I think it's more the storage argument than it is, say, weather, although I even argued the opposite at various points earlier this week, reflecting a bit and I guess cooling my jets. It probably was specs cutting positions after capturing a healthy rally with this potential change in storage mandates going forward. And to be, I guess, very clear on what the path forward is. And, I say very clear, it's crystal ball. They're always cloudy. Any semblance of cold weather returning to Europe over the next month and a half, 2 months, we'll get TTF going again. And don't be surprised if we blow right through the recent high of, call it 1750 in MMBTU. Yeah. I mean, European stocks, you've seen the already healthy year-over-year storage deficit expand by 100 Bs in just the last 10 days. We're sub 1.8 TCF. You probably know where that is in percentage terms because that's how Europe likes to speak in terms of its storage mandates.
I think we're down about 45% now. So it's 46 through February 12th. So for sure down below that. And to your point on the weather side, you did have the 15-day outlook for Europe turn much warmer. So seeing a lot of warmth, especially in the Western countries there. But on the storage mandate, I think one of the points that you mentioned last week, and we've talked about this a little bit on the side, is just what that potential relaxation of storage mandates could mean for late 2025 cold weather kind of reactions and new risks that they would invite if storage operators are delaying their refill until, say, October, because you have a pretty flat curve through October. But what's your new thought after?
So the market's lower, but it's been a parallel shift down. We didn't change the shape of the TTF curve at all. It was flat at, let's just use a round number, say $17 just a few days ago or to begin this week. And now it's flat at $15.75. So, in a classic economic sense, the incentive to inject would require today pricing lower than sometime in the future. And I think the point that you're making there is the most relevant one. Flat curve or not, buy now or buy later, the longer you wait, the greater you increase the risk of having to price back to levels that no one is contemplating now, meaning $50 in MMBTU or more. Without access to adequate flowing supply, you lean on storage. When storage gets depleted, and certainly if it starts at a lower level, then that's where you get into these parabolic moves. I mean, we've even seen that in the domestic market, here in the US. Not that, it's been eye-popping in most markets, but just in the few bouts of cold that we've had, you see daily pricing go up, $7-8. We got another round of cold coming next week. We'll see what that ends up leading to. But, the plan itself seems a little short-sighted of we're afraid prices will go higher if we buy too much. So we're going to wait. We're waiting until it's crystal clear that there is not enough flowing supply, meaning you do draw storage, thus the name withdrawal season is I don't know. I think you should volunteer to be a energy policymaker in Europe. Maybe you can get you a nice setup in Switzerland or something.
That'd be an interesting gig, especially with less and less diversification in their supply side. And, on kind of the crude side of the Russia topic, returning to that, I think there's an interesting kind of scenario debate that we could have for a long time with no clear answer per se. But what does this mean for kind of the flow of energy molecules, crude and natural gas, around the world, with potential end to the Ukraine conflict, that really kicked off in 2022, this restructuring that sent Russian gas from its primary market in Europe to now predominantly sending a lot of molecules to China and India and broader Asia, which is a pretty fascinating topic to really dig into, because you have all these security of your supply routes and things like that. But do you think that this negotiations between the U.S. and Russia and Ukraine has a material impact to restoring kind of these quote unquote normal flows? Or do you think that what we have now is more or less the new normal?
Honestly, hard to say. Put me on the spot with that one. Is it going to change? I would say let's talk timing instead of does it change? Does it change materially in the next 3 to 6 months? Probably not. What causes material changes in trade flows are extreme price moves. Energy markets, probably more than most, do still stick with, some pure economic themes. And while governments can step in and monkey with how things should work, and we see that, consistently for many decades, I think in the reality, unless Europe prices to demand all available barrels, including Russian barrels, to head their way, we won't see a shift back. Because that's really what we're talking about when we're talking about going back to the way it was. It was all we really saw was more of Russian energy supply shifting to Asia and India. I guess you include that in there, but and away from Europe. And then, the U.S. supplies more to Europe. And, would that in theory change? Yes and no. If Europe wants it more than Asia does, then sure. But then where does that leave the U.S. supply heading?
Yeah. And it's also, I think, it's kind of when you're looking at the demand side of it too, and what the next 10 years most likely will look like, it's very similar to what we talked about a couple of weeks ago with refinery build outs across the world, and which regions have been leading that for the last 10, 20 years. It's the Middle East and Asia. And so if you're planning for the future, it doesn't really offer much hope for the U.S. barrels in Europe when you have European demand pretty much flat to down for the last 15 years, especially on a per capita basis. Europe is falling faster than every other region in the world. So the long-term outlook for Europe seems a little bit less rosy than Asia. So ultimately, it seems like you just have an extension of what we have now, maybe with more competition in that region with U.S. barrels.
Yeah, I think we're talking, really distilling all this down is, where are we heading price-wise? Are we going to price to incentivize more supply? And that, the 800-pound gorilla that's been in the room since October of 22 is, well, there's a lot available now. How long will that, stick around? And that's the OPEC barrels, while this side of the world has still got significant productive potential. Canada, U.S., Guyana, now Suriname, there's a lot of supply that can also hit global markets. I don't think we're going to find ourselves desperately short oil in the next 10 years for any extended period. Whether the argument that we have underinvested in energy is a reasonable one, but it's also a function of time. How fast am I going to need it and where? In some ways, you're trying to predict what Mother Nature is, requiring in terms of, new BTUs of what form and of what fashion and where.
Yeah.
Which is a good one. I don't know. We'll talk about where. Let's go from the where.
Yeah.
Like how is crude flowing now? Like you had some interesting thoughts on ship traffic and how we're moving energy around the world.
Yeah, so this is particularly interesting as we have the ceasefire negotiations going on now with the Russia, Ukraine, as we just talked about, but also in the Middle East, where we have the Israel-Hamas ceasefire negotiations, which middle of this week were kind of shaping up to go back into pretty uncertain territory. But for the sake of just this short segment, say that those continue. You have the Houthi rebels in Yemen who have been supporting the kind of coalition of Iran-sponsored proxies, which includes Hamas, by attacking Red Sea vessels. So that was drones, missiles, and they had several successful strikes on a couple tankers, some cargoes that were ultimately driving traffic away from the Red Sea, which is a feeder into the Suez Canal, and around Africa's Cape of Good Hope, if those flows were going to flow from, say, Eastern Hemisphere to Western Hemisphere or Western to Eastern. So when we looked at the 2024 traffic through the Suez Canal, pre-conflict in the region, this was handling about 8 to 10% of all energy flows, and traffic fell 55% in 2024 compared to 2023, so substantial. And simultaneously to the Suez Canal issues, really with the Red Sea Houthi attacks, you have drought in Panama, or low water levels, record low water levels in Gatun Lake, which is the artificial lake that is used to put water into the locks and basically enable all of the flow of traffic through the Panama Canal. So you have the Panama Canal Authority restrict the number of vessels and the size of vessels that can go through to kind of keep those water levels in check. 2024, kind of first half, that's all going on, second half of 2023, and you have full year of traffic through the Panama Canal fall almost 20%. So you have two of the most important choke points for energy and goods flows to the U.S. from Asia, and also energy from the U.S. to Asia. So two pretty material impacts. And when we look at what happened to Cape of Good Hope going around Africa, that increased 63% year over year. So people are having to take a much longer route to get the goods to whichever Eastern or Western Hemisphere region that they're trying to. And pretty quickly here, I think we're going to have the potential to see that change pretty drastically. And I think that also kind of gets us into an interesting conversation about what this means for inflation, because all of those incremental costs are now adding into each good that is, say, imported to the US. And US expectations, inflation expectations this year have kind of, I don't know, I'd say materially shifted towards massive upside risk, and for interest rates, that is translated into expectations for one interest rate cut in 2025. So this is kind of the market consensus, the driving narrative. It does seem like that trade impact could be a surprise that the market does not really price in adequately right now. And how that affects energy flows, maybe you can add in some specific context if you'd like.
Man, I think you're making America great again right there with those comments. It would be a wonderful thing, I think, in restoring order. Opening the path through the Suez Canal and the Panama Canal back up again versus going all the way around the Horn. I guess I should say the Hope, since the other Cape is called Horn. Sorry, baseball reference. You just logically, if our trade routes are shorter, we're using less fuel to get whatever it is that we need to get from A to B. That's bearish energy demand. I'm burning less diesel to get, whether it's, oil that I'm moving, refined products that I'm moving, food, whatever it is. Mm-hmm. I think that would be a welcome sign for the average consumer around the world. Yeah. For the energy producer, it could actually even be a positive. If, it's access to a greater number of market participants. Yeah. If you're limited because of your ability to deliver a reasonable cost, and that gets minimized. So, maybe it is the opposite of what OPEC is predicting in terms of volatility and market uncertainty. Maybe just free flowing barrels actually are the offset to whatever, Trump is planning, which, you can't make this stuff up. Like, no matter what we talk about, you can come back and talk about President Trump. We just talked about Panama Canal and Panama. Hey, there's a Trump storyline there. I guess we can't really talk about South Africa. Don't think he's been involved there at all. But Elon Musk and the good old Doge team, I'm pretty sure his family originates from South Africa. So I guess we're kind of related. Suez Canal, of course, we can find a Trump storyline there. Another area where he certainly went and angered many. Yeah, we're just going to come in and redevelop Gaza. And I don't know, like even some of the laughable memes and tweets out there, we're just going to make Gaza a resort town and relocate all of these people. I mean, it's not funny, but it just shows how kind of wild this very short period of the new Trump administration is and how involved it is all over the world with whatever topic we can bring up as it relates to energy.
I think the world leaders call it outside of the box thinking after those meetings. So it'll be interesting to see. I think when looking at the impacts to energy markets with those choke points, one of the things that I think is important to recognize is the volatility impacts of regionally limiting access, as you were talking about there. I think that's a really important point because, say, in Asia, when you have your refined product exports, if those can't easily get to Europe, that's just going to be putting a lot of pressure on Asian refined product markets. And so you have this regional constraint that is maybe adding volatility to that region when it's not necessarily affecting other regions. And maybe that normalization kind of eases that, to your point. So I think that's interesting. One of the related points to the free flow of U.S. energy is this tariff conversation, continuing on that President Trump theme, where you have a lot of major exporters in the world very publicly, very vocally announcing their plans to increase their purchases of U.S. energy exports. And predominantly that has looked like U.S. LNG. You have 4 of the 5 largest LNG importers in the world. They're in Asia. So you have Japan, South Korea, India, and Taiwan, who have all announced their plans to either take a stake in a U.S. LNG project or sign a long-term supply contract for U.S. LNG. And then you look at what's going on in Europe right now. They have a pretty substantial trade surplus against the United States. We're a meaningful part of their GDP and very fearful of what tariffs on their exports would mean. So similarly, they are interested in increasing their imports of U.S. energy, predominantly LNG. So I think there's kind of a question here of what does this mean for U.S. LNG specifically, and how does new LNG supply kind of fit into that? And I think that we talked about this on the webinar in the fall. You had a great little chart that you threw in there. I think people should go and check that out. We still have the link to that somewhere. But maybe if you can give your thoughts on U.S. LNG export capacity in the next, say, year, and maybe what that means for the U.S.
I think it's a pretty well-known fact. And at this point, we've actually got real flow data. The latest additions, the Plaquemines facility, which has gone up, near 1.5 BCF a day, not quite made it there. Started a little later, but has ramped a little faster, is the way I would quantify the path for Plaquemines. And then you've got the Corpus Christi expansion, which is a little harder to pinpoint because the flow of gas on intrastate pipes to that Corpus Christi LNG export facility. If you add, what's possible from those two, what does that mean for 2025? I think it's, pretty reasonable to say that by mid 25, you've got consistently another 2 BCF a day U.S. LNG export capacity. And then in theory, you could have Golden Pass by late 26. And then if, you just kind of assume a pretty ratable ramp up period, you've got you're getting close in that 2 to 3 BCF range by the end of 25. Beyond 25, I think, and here we go, right back to Trump, the new administration's plans and the flurry of executive orders, paving the way for a faster permitting process, which doesn't really change the construction schedule, but as it does help you to get your shovel in the ground faster. There's a long laundry list. Could there be another 10 BCF a day online in 5 years? Yes. Is it likely that we'll have another 3 to 4 in the next 3 to 4 years? Yes. Are the lofty goals of another 20 BCF a day possible? Sure. At that point, though, we're talking about what's the next administration, and tying back to one of our earlier comments, all right, who's tomorrow's energy department? Are we going to just take another 180 turn? The fascinating thing to me, like where you started with these large LNG importers of U.S. produced gas, U.S. liquefied gas, stepping up and saying they're going to buy more. It's pretty fascinating to me. You're not going to buy any more than you've been buying, really, because you don't have this, excess storage capacity with which to put all these excess purchases in. It's really just symbolic, saying, hey, please don't tariff me. I'm going to ensure that I'm buying some of the stuff that you want to sell. I'm on board with your plan. Please don't tariff me.
Yeah. It seems like it's certainly a question for Qatar and what Qatar's investments are going to look like, because they have a lot of capacity coming online with their North Field expansion. I don't know if you have the exact number by 2027. But pretty material. And then you also have pretty material growth coming out of the US and Russia. So as Asia says, hey, we're going to seek more US LNG, does raise some questions. What does this mean for all the other capacity that's coming online? One of the just kind of interesting data points, you have other variables at play, obviously, but from the beginning of the first Trump administration, the same tariff conversation was at play for a lot of these big exporters because of the massive surplus that was expanding pre-Trump. Those same four importers I mentioned, Japan, South Korea, India, Taiwan, their collective imports increased 232% over the first Trump administration. So that's 0.6 BCF a day. That's an average in 2017 to an average of 2.1 BCF a day in 2020. That got up to about 3 in 2021 and then fell down to say 2.3-ish and then 2.8 last year. So it was pretty interesting to see what happened during the first Trump administration. The tariff threat seems pretty real to a lot of these exporters, especially when you look at, say, Germany and those same four exporters I just mentioned. Germany just posted a record surplus against the United States in December. That's a target right there. And then when you look at the aggregate U.S. trade balance in December, that hit a record deficit. It's like 121 billion. So that's been expanding pretty materially. It's double what it was in December of 2019. So I think the threat is real, especially when you see the share of relative GDP that the U.S. contributes to their economies versus what they represent in our economy and what trade represents in our economy. Looking at Canada, 70% of their GDP comes from trade, 20% of ours, 24%, I think is the right number. So I think we have quite a bit of leverage there. Be interesting to see if that expands to maybe investment in the U.S. and incremental demand growth for industrial consumption, manufacturing, things like that. So I'd say those are maybe
It's like an interesting conundrum when you think about that. So you bring more foreign dollars into the U.S. to spur some industrial growth, which thus eats up more U.S. produced energy, which makes the cost of buying the U.S. energy for export to you more expensive. Yeah. It would be really fascinating to see how all this unfolds.
There's a lot of conflicting, vectors.
And I still think Mexico's in this really fascinating position. Claudia Sheinbaum and the new Mexican administration has certainly made some announcements and some plans to, I guess more than anything, normalize the path forward for energy production, consumption, everything from, and even last year, before she took over, we already started building a massive new fertilizer plant in Mexico. I think Mexico's in this really interesting position in that it's got coastlines that avoid any Panama Canal issues that are, deep water, easily accessible, cleaner. Clearly, there would need to be some massive build out of ports in Mexico to make Mexico become a meaningful trade route. But then you think about the path of energy to Mexico or its own domestic energy production. I've been long Mexico for quite a while. Maybe I just like their beaches and their food. But it's this like interesting thing in that we've got this reshuffling of who is getting what from who needs what from who, and how are the governmental actions going to incentivize or penalize the flow of goods. Fun times ahead. And I think these are topics we could spin off, and there's a whole podcast on that just by itself for every day for the next 5 years. With energy, I think you hit the nail on the head earlier in saying that energy is at the apex of security concerns. You can't launch a bomb or a rocket without energy. It's hard to grow food without energy. Or even if you grew it, certainly without energy, we grew food for, hundreds and hundreds of years, centuries. So I say that loosely. Clearly, food can be grown without any oil or gas, but we've shifted the way we do it. Fertilizer being highly relied upon. But then even if you're growing it, you still got to move it. Very few places in the world are they just self-contained ecosystems. Big food producers, Canada, India, Brazil, they're exporting a lot of what they produce in the way of food to other places in the world. So interesting to see how all of this ends up translating to the flow of products around the world. One of the ones that I'm going to get off the topic, maybe as we near a bit of a conclusion here. One of the things I find really fascinating in this reshuffling is just a reflection on the last, I'm going to say, 5 to 10 years, and this push for renewables. In a lot of ways, the more that you want to generate power with renewables, the more you're immediately increasing your reliance on fossil fuels, namely oil. So renewables equal greater oil demand because the plastics and all of the products that are required to build the renewable generation facilities are highly levered to oil, which then in the end make the market highly levered to gas because the renewables are intermittent. And so in some ways, I want renewables because I want to get off of fossil fuels. Well, nope, you're going to get on oil more now, and then inversely, the more that you're reliant on natural gas now, like if let's say the script is flipped, the more you're reliant on natural gas, the more you are going to have to produce more oil. In the U.S., a substantial portion of our available MMBTUs, which in large part is really what spurred the revolution of flipping from an LNG importing country to an LNG exporting country, is the gas that came along with oil. Highly interrelated in the paths on the way they intersect. I think are also fascinating.
I think the Monday Daily that you had, I think that's maybe a good place to wrap up, just kind of recapping what you pointed out with the commentary from new U.S. Energy Secretary versus the historical data from the DOE. Maybe if you just want to.
Yeah, I mean, Chris Wright, I think, is a very interesting character. I've had the pleasure of being at a few conferences with him and hearing him speak. I mean, he certainly grabs your attention. He's energetic, I think very knowledgeable. He's had a great deal of success in the energy sector. But I found it really fascinating the way that a question was answered. So in an interview on Bloomberg TV, he was asked what the prospects were for oil production going forward. And I'll paraphrase. The answer was, well, yeah, with enough investment in infrastructure, the growth can be prolific. Now, I don't think it's going to be substantial in the next, few years, but 5 to 10 years from now, it could be very significant. Without even being asked, he shifted and made a comment about natural gas and how there would be significant natural gas production growth in the next couple of years, which would imply that gas can grow faster or is more likely to grow than oil production. When you look back over the past decade and just using his own entity, the DOE's data or the EIA's production data, oil production since 2012 is up 220%, and marketed gas production is up 163%. So gas production, apparently, according to the DOE, does not grow faster than oil production. And if anything, grows a bit slower. And certainly you can say, well, yeah, but a lot of that is flared. If we weren't flaring it, they would be equal. Okay, fine. Still equal. And maybe we should capture more of it. But there's this prevailing view that the really global markets trust and believe and are consistently told that gas comes out of the ground almost just with someone walking across it and asking for gas to flow up freely. And oil production is very difficult to get to, requires a great deal of spending, and we're probably not going to have enough. How inverted they are in terms of the reality looking back and the narrative going forward is pretty interesting.
Yeah, absolutely. Yeah, it will be interesting to see how the infrastructure affects, as you just mentioned, the flaring and what kind of incremental, quote unquote, production growth, because we kind of know that stuff, that flared gas, the surplus gas, is not always counted as production, depending on where it is flared or kind of the downstream path for it. So it'll be interesting to watch that. But yeah, it is an interesting narrative that is maybe not grounded at least in the historical data. So maybe we're just getting gassier. I don't know. But with that, I think we will call it for this week and throw some of the data in the show notes. And I will see you again next Friday.
Looking forward to it. Thanks, Alex.
All right. Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.